Hey there. Welcome to session 11 of 30, the Startup Money Playbook. Now, in this session, the topic is budgeting and forecasting, building your 12-month plan. So, if you may recall, in the last session, you learned how to read financials, basically, right? So, today, you will learn how to build a very important, shift that is understanding the past to predicting the future. This is what we are going to actually see. Remember two key ideas which are really very important. One is budgeting and second one is forecasting, right? You must have seen how budget sessions are actually done. A budget without variance analysis is just a wish, and a forecast that is never updated is just fiction. So, in this session, you will learn the difference between a budget and a forecast, bottom up and top down forecasting, how to define revenue drivers and cost drivers, how to build three scenarios: base, bull, and bear, and how to update your forecast every month. Now, this session is designed for students, founders, teachers, professionals, maybe investors, right? So, during this entire session, uh, we will actually, cover all these topics, and you'll be able to build and defend a complete 12-month financial plan by the end, right? So let's get started. We'll start with the recap. And yeah, so if you look at what we studied, like look at the first point, 25 ratios, across five categories, right? What you learned was uh, the first one was profitability, liquidity, then leverage, efficiency, valuation. Together, these give a complete scorecard of a business. We saw how Study AI scored, all uh, right, green in all 25. The next point, what we understood was context is everything. A ratio alone has actually no meaning. It must always be compared with industry benchmarks, right? We saw this example. A debt to equity of 10 times is actually dangerous for a software company, but it's actually normal for a bank. Then, point three is track five ratios monthly. So you must track five key ratios every month. This is what we understood. Gross margin percentage, it's net profit margin, operating cash flow, current ratio, then LTV to CAC. So if any of these, drops, you may remember I've been telling for two consecutive months, then you must stop and diagnose immediately, right? Now, let's fast forward to today. It's, till now you learned how to read financial history, but we'll now be moving to building financial futures. What you're going to build will be a 12-month forecast, three scenarios, and defend each, assumption. So, from analysis to planning, this is the shift in this session. So, let's clearly understand what we will cover in this session. We actually begin with a real founder story. A founder, presents a 10 crore forecast, let's say, but cannot explain a single assumption. Then we'll move on to understanding the difference between a budget and a forecast. A forecast is your best current estimate, and we'll understand the reasons. And most founders confuse actually between the two, right? Then there are two methods of forecasting. That's what we will touch upon: bottom up and top down. So we will learn when to use each and why bottom up is more credible, actually, right? Then we'll understand the revenue drivers. Every revenue number must come from some driver, right? For example, downloads, it could be price, it could be conversion rate, and all assumptions must be written clearly. Then, of course, cost drivers and operating model. We break costs into fixed costs and variable costs per unit, and this becomes the base of your financial model. Three scenarios. We build actually a base case, bull case, and bear case, and each scenario tells a very different story. So after this entire session, obviously, You'll be able to build, again, I'm telling you, a 12-month P&L forecast, defend every assumption, choose the right forecasting method, build all three scenarios, and update the forecast monthly. So this session is all about building clarity and removing the guesswork. Okay, so here is that opening slide for
It's
the
2 o'clock.
forecast, not assumption, and not one, but assumption. Okay, so let's move on. The question that actually killed the entire pitch, and the entrepreneur, 26-year-old founder from Bangalore, walks into a seed round pitch, and he's in slide number 8. And this is what you actually see, right? Year one, 2.4 crore. And these are all of course, the projections. Year two, he's saying 6.8. Year three is 10.2. So these numbers are really, really amazing. So the investor looks up and asks one very simple question. How many customers do you need in year one to reach actually 2.4 crore? The founder pauses for a few seconds. In fact, it's a long pause. And then he says around 2,000 customers. The investor then asks the next question. What is your current monthly customer acquisition rate? And the founder replies, about 80 customers per month. Now the investor does the math. It's very simple. So if you're adding 80 customers per month, then in 1 year, 80 multiplied by 12 will be 960 customers, correct? But you need 2,000 customers. So how long will it take? Because 2,000 divided by 80 will actually take 25 months. So that is more than 2 years. Okay. But your forecast actually assumes, you will achieve this in 12 months. So there's a mismatch in the calculation, I think, right? And that's where the pitch ends. So let's understand what went wrong. Was it just a math? No. So every revenue must come from a clear driver. Okay, not just 2.4 crore revenue, but something like 200 customers multiplied by 1,000 per month multiplied by 12 months, which actually equals 24 lakh. Now, every number must have a source, right? Second, every assumption must be written down, whether it's a conversion rate, churn rate, acquisition channel, everything must be visible and explainable. The third one is the math must be consistent. If your inputs say 25 months, your forecast actually cannot say 12 months. And don't do this kind of basic math error. Investors will always check this. Okay. So the insight here is a forecast without assumptions is just a spreadsheet with some random numbers. Assumptions are the real forecast. The numbers are just the output. Okay. So let's understand budget versus forecast and whether both of them are not the same. Right? Uh, and what happens usually is most founders, they actually use them interchangeably. And that's where they do a mistake. Uh, what exactly is a budget? A budget is set once a year. So it's an actually annual plan, right? Usually before the year begins. And it's fixed. It does not change, based on any new information. You must have seen how in the parliament the budget session actually happens. It's all fixed. The budget is used to set targets. Even in our household monthly budgets we do have, right? But sometimes there are unexpected spendings or expenditure which probably wouldn't have been budgeted. But that actually happens. So a budget is used to set targets, measure performance, and decide bonuses, right? So variance here means budget versus actuals, right? If the budget is wrong, it is treated as a performance issue. For example, if you say we planned 50 lakh revenue this quarter, right? Forecast, on the other hand, it's the best current estimate. A forecast is updated regularly, monthly, or quarterly. It's dynamic. It changes as new information comes in. A forecast is used for decision making and capital planning. Variance here means forecast versus actuals, not budget versus actuals. Okay. If the forecast is wrong, you update it. That is the whole point. We now expect, for example, 42 lakh this quarter. And here is why. So you give that reason, right? Take the study AI approach. Budget is set once in December. The next year, budget is updated every month, maybe on the 5th, right? Both exist together in the same workbook. So finally, a budget is a plan, a forecast is reality as you understand it today, right? Now, let's understand the bottom up and top down, and let's try to use both. We'll understand the scenarios, okay? But both of them, they serve different purposes. So, what is this bottom up forecasting? Now, this starts from unit level assumptions. Let's start at Study AI. Month one downloads are 400, monthly growth rate is 12%, price is 99 per download, churn is 3% per month. Churn, you remember, no, number of customers leaving. Okay. Now the next what you see is a new subject which is getting launched in month 5, and this actually adds 200 downloads per month, and by month 12 the downloads reach approximately some 1580. Now, based on all these assumptions, year 2 revenue actually becomes 53.8 lakh. So where are you starting? Okay, every number comes from a clear assumption that makes it credible. So you started from month and you move towards the year, right? This is very important. This is called bottom up. Now let's take the top down approach. Okay, now this starts from the market size. uh, for example, let's calculate total CBSE students in India, 2.5 crore nearly. The target segment is class 9th to 12th. Now, 40% of 2.5 would be equal to 1 crore students. Now assume the adoption rate is 8%. Okay, digital adoption. So here 1 crore multiplied by 8%, of course it will be 8 lakh users. Now let's assume that the market share for study here would be like 0.015%. That number will be close to 1200. Okay. So now how do you calculate the revenue? 1200 multiplied by 99 multiplied by 12, that is equal to 14.3 lakh. So compare both of them. The bottom of forecast is 53.8 lakh. Top down estimate is 14.3 lakh, right? So there's a large gap. Now this gap is your growth story. You must explain or reduce your assumptions then. Okay. So when to use? Bottom up is used for investor pitches, board reviews, early stage planning, because it is detailed and defendable. Top down is used for market sizing, basically strategy, vision decks, because it's very quick and shows opportunity. Okay. So the insight here is bottom up gives credibility, top down gives a sanity check. Use both, but never rely only on top down. Now we move to one of the most important ideas in forecasting, right? Every revenue line must come from a driver. Let's look at Study AI's year 3, revenue model. Okay. Now stream 1, single subject downloads. Very simple. So here the assumption is the growth driver, of course, is downloads per month. Assumption is growth from 1580 download to 2400 downloads per month, which is about 4% growth per month. So the revenue from this stream is 28.5 lakh. What's the reason? It's an organic growth. Plus there's an SEO, search engine optimization, from 200, let's say, blog posts. Let's understand the stream 2. Now you are adding that subject bundle pack. Here the driver is now no longer the download with the conversion rate. Okay. The assumption here is 8% of users, they upgrade to bundle packs. So from here your revenue becomes 18.2 lakh. Right. What you are essentially doing is upselling. Upsell happens after completing a particular subject. Then there's a third revenue stream that you've added. That's called the annual subscription. And here the driver is the renewal rate. Okay. So, and the assumption is 40% users renew at, let's say, 799 per year, because they will feel that anyway they need, and the 12-month pricing is nearly half what they have to actually pay every month, 99. Right. So here, the revenue from here you get is 12.8 lakh. Okay. And what's the reason? Exam cycles, they drive long-term commitment. Then there's a fourth revenue stream, that is school licensing. And here the driver is number of schools. So assumption is 15 schools, each paying 12,000 rupees per year. Now let's calculate. 15 multiplied by 12,000 will give you 1,18,000, 80,000, which is, right, an amount, which is also a decent amount, I will say. There's another thing that is stream 5, uh, which will be tutoring, marketplace, right? Because a lot of them may face difficulties and they want a tutor. So the driver here will be bookings per month. And let's take an assumption. Assumption is per month, such bookings are 50 sessions per month, and let's say at 400 rupees per session. Okay. So the monthly revenue will be very simple, 50 multiplied by 400. So there's an additional revenue of 20,000 rupees per month. Okay. And then you multiply it by 12, you get 2,40,000. Now this feature launches in month 7. So it has a lower certainty, right? So when you add up all the revenue streams like 28.5, 18.2, 12.8, 1.8, 2.4, all you're getting is 63.7. So this is essentially a 38% increase over year 2 revenue of 46.1 lakh, right? Adjusted. Okay. So the revenue will grow 50%, right? Kind of statement when you give is not a driver. But when you say downloads grow 4% per month because of 200 SEO blog posts, this is actually a real driver. So you should be able to articulate and know the exact reasons, which are the drivers. Okay. Let's move to the second half of the model, and that's the cost drivers. So we break cost into two parts, fixed costs and variable costs per unit. Okay. So what are fixed costs? These are usually calculated, monthly schedule we're going to do. So these costs do not change with the number of users. Okay. Let's try to list them down. For example, you have a content writer salary, which is 18,000 rupees per month, and that increases to 22 from month 7. After month 6, it remains 18,000 rupees. Then there's a hosted infrastructure, 5,500 per month. Software and tools, 3,800 per month. There's a founder salary, 25,000 per month. Marketing base spend, 15,000 per month. There's a loan EMI, right? 1661 per month. So you have to go back to session 2 and 3 to, remember to understand how we calculated. And when you add all these things, right, 18,000 to 1,661, all you're going to get is 68,961 per month, right? The annual fixed cost, obviously you have to multiply this by 12 because 68,961 was monthly. All you get is 8.27 lakh approximately for the year. Fixed cost. Now let's calculate the variable costs, and this is per unit. And these costs increase with each customer, obviously. So there's a payment gateway fee, 7 rupees transaction. There's a cloud storage, 0.5 rupees or 50 paise per user. There's a customer support, let's say 2 rupees per user. Some referral commission, 5 rupees per user. When you add up, you get 14.5 rupees per user. You're selling at 99, right? So essentially, your contribution margin now becomes from 99 rupees as a revenue. You subtract this 14.5, right? That's a formula. You get it as 84.5. If you divide this by now 99, which is the price per download, right, that will be 85.4%. That's the margin percentage that you're actually calculating. Okay. So operating leverage will now be, let's see how the profit is actually scaling. We take the case 1, 1,200 downloads. Revenue is 1,18,800. The variable costs is, you multiply 1,200 by 14.5, is 17,400. So the fixed cost is 68,961. Okay. Now, when you calculate the profit, you take the revenue, subtract 17,400, right, and then you subtract the fixed cost as well, the 68,000. What you get is 32,439. Now, if you calculate the margin, you will get 32 net margin, 32,439. If you divide by revenue, you will get that. So this is 27.3 percentage. You take the other case, 1,600 downloads now, and do the same math, what we discussed. Right, so the revenue will be 1,58,400. Now divide the so calculate the variable cost, which is 1,600 multiplied by 14.5, that is 23,200. The profit that you're going to get here in this case will be 66,239, right? And if you calculate with percentage, it is 41.8. You take the other case, if you get 2,400 downloads, right? And if you just look at the profit percentage, it will be 56.3%. So what is the insight? The insight is as revenue increases, fixed costs, they stay constant. Okay, so profit actually grows faster than revenue. This is actually the operating leverage, right? Now let's understand, base, bull, and bear. Okay, all these scenarios. So I will say that a single forecast is just an opinion, right? And when you look at the three scenarios, it becomes a strategy. Okay, let's go one by one. The most likely outcome is the base case. Okay, this is your actual, the realistic one. The key assumptions are monthly download growth is, let's say, 4%. So price stays at 99. One new subject launches in month 5. Churn stays at 3. School licensing 15 schools. So what's your result? Revenue is 63.7 lakh and net profit is 29.4 lakh. And margin, of course, is 46.2%. Let us take the bull case. Everything goes right. This is your upside scenario. So here the monthly growth now increases from 4 to 8%. The price has now increased from 99 to 129, and that is in month 4. Right. 3 new subject categories launched. Churn improves to 2%. Right. So the churn should always reduce, right? You should always be able to retain customers. School licensing now increases from 15 to 35. What is the net result? Revenue is now, 104.2 lakhs. Net profit is 58.6 lakh. So the margin has now increased. Here, when I'm referring to margin, it's the net margin, so 56.2%. Now let's take the bear case. Things go wrong. This is your downside scenario. The key assumption here is your monthly growth drops to 1%. Price remains the same, of course. There are no new category launches. Churn increases to 5%. School licensing drops to 5 schools. So what's your revenue? 32.1 lakh. Net profit is 4.8 lakh. Your net margin is 15%. Okay. So the base case is used for day-to-day operations. Bull is used for investor discussions and growth ambition. Bear case, if you look at, is used for stress testing and deciding when to raise funds. Okay. So the final thought is very simple. One forecast is a guess, 3 scenarios, a complete strategy. So let's move to one of the most important practices, and we'll study here that's called variance analysis. Okay. This means you're comparing the budget versus actuals and you're explaining every gap. We'll take the StudyAI's month 8 example. Here the budget is so let's understand the downloads and right section we will see first. Budget is 1050. The actual is 1240. What's the difference? The difference is 190, but this difference is extra downloads. So this is an 18% increase because you budgeted less. You thought that, okay, there'll be 1050 downloads only. Now, what is the reason? The reason is simple. There's an SEO blog post that performed better than expected. Okay. So what will be the action? Scale the content team, right? Now let's take average, uh, revenue per download. If you look at the budget, it's 99, actual is 99, there's no difference. That means pricing exactly on plan. Okay, now do the next step. Price test scheduled for month 10. What you have budgeted is rupees 1 lakh 3,950 as a total revenue, and your actual is 1 lakh 22,760. So here also it's more. So the difference is 18,800, 10 higher revenue. The reason is high volumes of downloads. Okay. Razor pay fees. Budget is 8,624, but the actual is 8,593, right? And this is what the variable cost, what we actually discussed. So the difference is 31 rupees lower, which is about 0.4%. But this is within range, so no action needed. Okay. Then comes the content writer cost. You budgeted 18,000, but the actual was 22,000. So the difference is 4,000. Because you have to pay more sometimes, right? So reason is early hiring decision. Action justified because output also increased. Okay. Take the marketing spend. The budget is 15,000, but the actual was 9,200. The difference is 5,800. What this means is marketing was underspent. Okay, so the action is relocate this to influencer testing in month 9. Okay, then comes the net profit. You budgeted 29,862, but what you got is 51,103. This difference is much higher. That's 21,241. Okay, what is the reason? Higher revenue and controlled costs. So the action is retain this cash, do not overspend. Monthly ritual. On the 5th of every month, create this table. Every positive variance must have a cause. Every negative variance must have an owner and a corrective action. Okay. So when investors see this level of clarity, they trust the founder. So if you have to recap, very simple. First point is a budget is a plan. It is set once, it remains fixed, but a forecast, on the other hand, is your best current estimate. It is updated regularly. Use both because they serve different purposes. Bottom up beats top down. Okay, bottom up forecasting starts from unit economics, downloads, price, growth rate, all that. Every number comes from a driver. Top down, on the other hand, is sanity check. So never use it alone. Then the three scenarios, okay, and each serves a purpose. Base is for operations, bull is for investors, bear is for survival planning. Always show all three. Monthly variance report. Every gap between budget and actuals must be explained. Every variance needs a cause and an owner. So this must be done on the 5th of every month, right? And these practices are what make a founder credible in front of investors. So now it's time to apply what you have learned. This week's task is build your own 12-month forecast. So all you have to do is follow these steps carefully. Right. First one is identify revenue streams. List all your revenue streams, right? For each stream, identify one key driver. For example, downloads, leads, conversions, number of clients. Step 2 is define current metrics and growth. So here you write down current monthly number for each driver, then write the growth rate you expect. And most importantly, write the why. Then step 3 is build monthly revenue. You calculate revenue, driver multiplied by price, multiplied by number of months. Do this for all 12 months. This becomes your base case forecast. Then you build your cost structure. List all your fixed costs in a monthly schedule. Then add variable cost per unit. Compare both to build your 12-month P&L. Then you create scenarios. Build two more scenarios. Bull case, you assume 50% better performance on your top two drivers. Bear case could be like you assume 30% worse performance on all drivers. Step 6 is compare with actuals. On the 5th of next month, compare with your forecast with actual numbers. If any gap is more than 10%, write one sentence explaining the reason. Use template T10, right? So you can go back to the previous sessions and or the first few sessions you will get. Download this entire thing, right? So 12-month forecast you will get, and this includes revenue driver model, fixed cost structure, variable cost tracker, bull bear, base, scenarios, variance table. Okay. Then, as usual, forecasting tip this time. The most common mistake is this: assuming current growth rate continues forever, but in reality, growth slows down. So after month 6, reduce your growth rate. This makes your forecast more realistic and more credible. Okay, this was obviously in context with uh, study AI, what I said. So if you want to actually think rather like a founder, you must build like one. Okay, so this is what it is. When to panic, warning signs. All this is what we will be, doing in the next session. So session 11 is actually complete from my side. You can now build, defend, and update your financial forecast. One key rule, if you want to remember, is very simple. A forecast without assumptions is just a spreadsheet with some random numbers, I'll say. 3 scenarios is a strategy. 1 scenario is just a guess. So update your forecast every month, right? And explain every gap always. See you in the next session. Thank you so much. Do like, subscribe, and take care.